G'day guys, it's Nathan here from Hunter Galloway. Hints from financial institutions about further increases in the cash rate have painted a very interesting picture for prospective home buyers. The cash rate is actually projected to hit 4.85% by September of this year, which indicates a continued upwards trend for the Reserve Bank of Australia. We've seen labour markets showing resilience despite threats of a recession and the unemployment figures declining, and this is a strong chance for further rate increases, particularly because of these factors. The reason the Reserve Bank of Australia is increasing interest rates is mainly driven by the concerns about prolonged inflation across Australia. While this might be worrying for those servicing mortgages or planning on buying homes, these measures are aimed at ensuring long-term stability. In terms of housing, the market for established homes has remained surprisingly resilient, and this is a little bit of a silver lining, especially for those considering entering the market or even trading up. Now, there is a requirement for more homes, especially because we've currently got a shortage in housing available. The problem we're seeing is that even the properties being built at the moment aren't necessarily being built in the desired locations where people want to live. This discrepancy arises from planning regulations and challenges faced by developers that impede them from expanding in cities that people actually want to live in. Remarkably, there's already a surplus of housing in desirable locations, and with appropriate policy adjustments, these could be made accessible. While the past year has seen an increase in rent and mortgage costs, there have been efforts geared towards boosting supply of housing to mitigate these shortages. Prominent among these is the government's housing plan, which promises to build over 1 million new homes over the next 5 years. However, one critical question remains unanswered. Where will these homes be located? If based on our current projections of the current development plans, these homes might not be located in the right locations where people actually desire to live. An effective solution to the housing shortage should be to prioritize building homes in areas close to major capital cities, places that already have high prices and plentiful services. And if you too find value in this video, please consider hitting that subscribe button, as it really helps out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content. We hope you enjoy. Interestingly, excess savings from the pandemic era could play a significant role in the trajectory of interest rates moving forward. If these savings are spent too quickly, this could put additional inflationary pressures, and the Reserve Bank would further need to increase interest rates further. For prospective home buyers, the present situation requires careful planning and navigation. The interest rate environment isn't a permanent state, but rather a response to temporary inflationary pressures and the broader global economic conditions. My advice for homeowners out there is to carefully evaluate your financial circumstances and future prospects. A fixed rate mortgage could provide certainty in an uncertain environment, but there can be penalties for early repayments. A variable rate mortgage offers more flexibility, but there is risks of further rate increases, meaning you're going to have a higher repayment. As always, it's best to seek independent mortgage advice from a mortgage broker like ourselves, where we can understand your situation and give you tailored solutions. And attention has been centered around the Reserve Bank of Australia's minutes from the June board meeting, which were more evenly balanced than we expected. There's no talk of further rate increases on the horizon. However, they did talk about persistently high inflation and the shift in housing trends that were identified as primary concerns. Looking at the strong labour market data from May and the Deputy Governor's remarks, we still believe that there's likely to be another rate rise in July alone. This expectation also stems from the continued surge in inflation due to services, and consumer price index in May projected to hit a yearly of 6%. However, upcoming increases in costs for electricity and housing could be another potential risk factor. Several financial institutions have also hinted that they believe that further rate rises are needing. For homeowners awaiting some reprieve on their mortgages, it's unlikely to come before September, where the cash rate is projected to hit 4.8%. The present cash rate is 4.1%, which suggests there'll be 3 more rate rises just around the corner. This disheartening forecast has been issued by prominent investment banks TD Securities, Goldman Sachs, and Capital Economics. Despite threats of a recession, Australia's unemployment rate has proven resilient. The resilient labour market has a potential to cause further inflationary expectations due to the surge in low productivity and potential for wage increases. Recent data from the Australian Bureau of Statistics revealed that even with many companies closing and downsizing downsizing, Australia's unemployment numbers have decreased. In May, unemployment was only at 3.6%, which is slightly down from the 3.7% we saw in April, indicating an additional 76,000 Australians secured jobs in the last 31 days. Expectations of a rise in unemployment is persisting, according to Treasurer Jim Chalmers. On top of this, Fair Work Commission decided last month to increase the minimum wage, which made additional rate hikes almost certain. Earlier this month, the Reserve Bank increased the cash rate by 25 basis points, which resulted in the cash rate hitting 4.1%. This drastic rise in interest rates from the low of 0.1 we saw many Australians that benefited for more than 2 years over the pandemic period. The RBA has increased the cash rate 12 times since May last year, which has made the cash rate the highest it's been in over 11 years. The Reserve Bank of Australia had observed that house prices had increased in recent months and household expectations of future rises in prices has strengthened. And adding to this, excess savings is a real wild card for the Reserve Bank of Australia. Over the pandemic period, households saved an extra $300 billion relative to pre-pandemic trends. If these savings are spent, it could add additional pressure on the Reserve Bank of Australia needing to raise the cash rate even further. The pace at which these excess savings are utilised will be crucial to consider. The Reserve Bank of Australia has to navigate a delicate balance between stimulating the economy and managing future inflation expectations. An overly aggressive policy might dampen economic activity and create undesirable ripple effects. However, if they're timid in their approach, it could let inflation spiral out of control and lead to a host of other problems. The Reserve Bank of Australia's increase in the cash rate also echoes global trends where central banks across the world are reassessing their monetary policies to adapt with post-pandemic economic realities. And remember to like, share, and subscribe to stay in tune with all things property and finance. Guys, where do you think the Reserve Bank's going to go with their cash rate? Do you think inflation is going to persist? We'd love to know in the comments section below. Did you know here at Hunter Galloway, we're a mortgage broker and deal with people Australia-wide. There's no cost for our service and you can contact us directly on 1300 088 065. We'd love to help, or visit our website huntergalloway.com.au. You can fill in a free contact form. We'll give you a buzz. Guys, as always, thanks for watching and we'll see you next time.